So today, we're going to unpack a really fascinating investment thesis in the MedTech space. It's all about a company called SANUWAVE Health, which finds itself right at the epicenter of a massive disruption in the wound care market. We're going to break down their record 2025 performance, the industry chaos they're navigating right now, and their whole strategy to turn what is a crisis for others into a major opportunity for them. And this quote from SANUWAVE CEO Morgan Frank, it just perfectly captures the whole situation we're exploring. The entire wound care industry has been thrown into complete turmoil. For some companies, it's a total crisis. But for others, it might just be a once-in-a-generation opportunity.
All right, so here's how we're going to tackle this. First, we'll dive into the industry crisis itself, what's actually happening. Then, we'll look at SANUWAVE's record results before getting real about the headwinds they're facing. After that, we'll unpack their growth strategy and wrap things up with their projections for the future.
Okay, let's jump right into our first section, the macro environment shift. And believe me, you've got to grasp this part to really see the bigger picture and the potential opening for SANUWAVE.
So what exactly happened? Well, the Centers for Medicare and Medicaid Services, or CMS, basically dropped a bomb on the industry. They completely changed how they pay for skin substitutes. These are advanced products for treating really severe wounds. The CEO put it pretty bluntly. He said it was like a grenade going off in the market.
And when I say they changed the reimbursement, I mean they slashed it by a staggering 90 to 95%. You can just imagine, this instantly sent a nearly $15 billion product category into a complete tailspin. It put just intense financial pressure on practitioners and companies all across the wound care space.
And this, right here, is the critical difference. While all their competitors are getting absolutely hammered by these cuts, SANUWAVE's main product, UltraMIST, is insulated. Its reimbursement code was completely unaffected. In fact, it even got a slight increase for 2026. This is the whole crux of the investment thesis. Chaos for competitors is a clear runway for SANUWAVE.
Now, it's really important to know that before this whole market imploded, SANUWAVE was already firing on all cylinders. This isn't some story about a struggling company getting a lucky break. No, this is about a strong performer running headfirst into a massive new opportunity.
Just take a look at their fourth quarter of 2025. They posted a record $13.4 million in revenue. That's a 30% jump from the year before, showing some serious momentum even as those industry storm clouds were gathering.
And you can see that demand in the unit sales too. In that same quarter, they sold an all-time high of 255 UltraMIST systems. Now, to put that in perspective, that didn't just beat their old record, it absolutely shattered it.
And if we zoom out to the full year 2025 results, the picture is just as impressive. Revenue grew 35% to $44.1 million, and Adjusted EBITDA was up a massive 89%. This shows some really powerful operational execution leading right into this big market shift.
Okay, so the foundation is strong and the opportunity is clear, but it's not all smooth sailing. That same crisis that's creating the opportunity, well, it's also creating some very real, near-term pain. So let's dig into the headwinds the company is facing right now.
And really, this is the question on every investor's mind, right? 2025 was fantastic, but what's happening on the ground now in the wake of all this disruption? And here's the tough part of that reality. In Q4 of 2025, the company had to remove 168 systems from its active systems count because of customer issues. So get this. Even while they were selling a record number of new systems, they were also losing a bunch of existing ones. The big question is why?
The CEO called Q1 an industry shock, and you can really see why. A lot of SANUWAVE's customers were just hit so hard by those CMS changes. Some actually went out of business. Others faced huge financial distress from payment clawbacks, which forced them to cut back on patient volumes. This is that tide going out he was talking about. So, how is management responding to all this chaos? Well, they aren't just sitting back and weathering the storm. They see what they're calling a land grab opportunity emerging from the rubble, and they've built a really clear strategy to go on the offensive.
It's basically a three-pronged attack. First, they are dramatically expanding their reseller network, getting more feet on the street to reach all this newly available white space in the market. Second, they're targeting brand new customer groups that are literally forming from the ashes of the old ones. And third, they're stepping up their R&D investment to develop new products and applications. And this is a really fascinating part of their customer acquisition strategy. Internally, they've come up with a term for a new type of customer, baby elephants.
These are newly formed wound care clinics, often started by practitioners who came from multiple different groups that shut down. They start small, but as one of them told the company, they have plans to add a 0 to their practitioner count by the end of the year. I mean, that's just massive growth potential.
All right, so that's the strategy for this wild new landscape. Let's move to our final section and see how all this translates into actual financial projections and the company's official outlook for the future. Okay, so here's the official guidance for 2026. You'll notice the slower growth in Q1. That's the direct impact of that industry shock we just talked about. But, and this is the key, look at the full-year guidance. It implies a significant acceleration as their new strategy really starts to take hold. This bar chart really tells that full-year story perfectly. They're moving from $44.1 million in 2025 to a guided range of $51 to $55 million for 2026. So despite those Q1 headwinds, that's an impressive 16 to 25% annual growth, which signals some real confidence in their strategy. So revenue is one thing, but what about profit, right? That's always the bottom line for investors. Well, management gave a very useful rule of thumb here. They expect about 50 cents of every new dollar of revenue to fall directly to the Adjusted EBITDA line. That tells you that the growth they're projecting should be highly profitable. So that brings us to the final central question of this whole thesis. We've seen the crisis, the company's strong foundation, the near-term headwinds, and their aggressive growth plan. The question for any investor considering this is simple. In a market being completely reshaped by crisis, can SANUWAVE truly capitalize on this disruption and emerge as a new leader in the wound care space?